Happy Wednesday, everybody. This is Alexandra Malenkina, and as usual, we're doing our Wednesday launch today, waiting for my partner, David Gazarian from the IQ Mortgage to join me, as well as a special guest that we're going to have today. And the special guest is going to be the tax professional. And the reason we're bringing a tax professional to today's live is because we're looking for for providing you guys extra advice. Give me 1 second. Okay, we got David.
And there's Crystal.
Hi guys. Good morning. How are you guys?
Good. How are you?
Great, and thank you so much, Crystal, for joining us, because we know it's a tax season. It's a busy season for you, and we're very appreciative that you found some time to actually address the questions. And we hope that those who are listening to us or maybe viewing this video in a recording would find this information not only useful, but they might have a little bit of time before their personal taxes due. Or, like for the future year, because it's never a long time between the taxes are due for the next year. So we're hoping that our listeners and our viewers will find this information useful, and maybe they will learn something new today from the tax benefits. And so the topic today is the tax benefits of owning the property. But before we jump in, Crystal, could you please introduce yourself, who you are, who you work for, and what do you do for a living?
Absolutely, yes. My name is Crystal Spivey. I am a tax professional at IQ Tax. I've been in the business for almost 10 years now, and I love it.
Almost 11.
Almost 11, yes.
I can't even imagine how many tax returns you went through.
Oh, yes.
Thousands.
In a season, it could be anything over 2,000, 2,500, so.
Per year.
Exactly.
Excellent. And once again, thank you so much for joining us. So, we're talking today about the tax benefits of owning real estate. Mm-hmm. And everybody knows that, everybody heard that there are some tax benefits, yes. But some people say that it only portrays for owning the personal residence. Some people say it's think that it is only for investment properties. Now, can you answer the question, other tax benefits for owning the real estate property, whether it's personal or investment property?
Absolutely, yeah. So when you own your own residence, of course, there's other benefits like gaining equity, not paying rent each month, but you also have the higher chance of being able to itemize each year, meaning that you can deduct your mortgage interest, property taxes, charitable donations. So it gives you that extra boost to be able to take extra deductions on your taxes each year.
So what do you see as the biggest deduction that every homeowner is using? Would it be the mortgage, mortgage interest? Would that be the biggest deduction?
Yes.
Or this is that everybody is entitled to?
Yes.
So could you tell us a little bit more? So let's say, how do I know how much mortgage interest I paid over the certain year?
At the end of the year, normally it comes in your January statement. You will get a 1098 from your
Servicer,
yes.
Yes. Mm-hmm.
And on that 1098, it will show you how much property interest you paid, mortgage interest paid, mortgage insurance premiums that you may have paid, and all of those deductions, if they equal up to the standard, you are able to itemize and take additional benefits.
You're going to start confusing people, Crystal.
Crystal, talk to us as we're 5-year-olds, because when it comes to taxes, we 100% depend on you like a brain surgeon. But talk to us like we're 5-year-olds.
Of course. I'm sorry. I always get into the lingo. But yes, so basically, when you get your mortgage interest statement, right off the top, it'll tell you how much mortgage interest you paid and the property taxes. And those two are the biggest things that will allow you to be able to take extra deductions on your tax return.
So if let's say, if I get a form like this and it says that I paid $25,000 worth of mortgage interest, interest and let's say $5,000 in taxes. And let's say I made $100,000 this year. So does it mean that this $25,000 is getting slashed and now I filed the taxes as though I made $75,000? Is that how it works?
Actually, no. So what it means is if you made $100,000, for one, like I said, was about the standard deduction. Everyone gets a standard deduction, no matter if you're filing single, married, head of household. The standard deduction is $12,500 for single and $25,000, a little over $25,000 if you are married. So if you are filing married and your mortgage interest is $25,000, technically you're just right at the middle point to where you're able to itemize slightly. So it's not a dollar for dollar deduction.
Okay.
Crystal, if I may say so, to make this simple, Alexandra. So the government will give everyone a standard deduction, whether you have any houses. If you don't, automatically a single person gets 12 and change, and a married couple gets 25,000 and change of deductions. And the government's like, if you think you have more deductions, by all means, use yours, which is called itemizing on a form called Schedule A. If you don't have more than 25,000, let's say you're renting.
Let's say I'm single and I have 25,000.
Let's say you're single, you have 25,000, which means by all means, the government's giving you 12,000 and you have 25,000. Obviously, you're going to itemize. Okay. Now, since your expenses are more, you're going to opt in to choose Schedule A, and Schedule A does have other expenses you could deduct, such as your car registration. There's deductions to goodwill, so donations. There's other things that Crystal can say, medical health insurance. So, yeah, once you trigger the Schedule A itemization, which means the triggering happens when you exceed the standard deduction, then there's a whole menu of expenses open up for you.
And once again, asking you the question as a 5-year-old, you said it's not dollar for dollar, so it is a fraction that is getting deducted, or?
Yes, so you're not taking the full expense. The more you are able to itemize, you are reducing your tax liability, giving you a bigger tax refund. Or in some cases, if you owe, you're reducing your tax liability.
Crystal, would I be accurate to say that your, let's say, $1 or whatever amount you deduct is reducing your percentage of tax you would pay your effective tax rate?
Your tax liability, yes.
Tax liability. So let's say you deduct 100,000, or 100,000 is too big of a number, but for this example's sake, Alexandra, if you deduct $100,000, then you're effectively in the 20% bracket. Then you're reducing $20,000 off taxes, actual dollars. Does that make sense? So you're reducing $100,000 of taxable income, but when it comes to your pocket, how much you're going to pay less, you're reducing by $20,000. So Schedule A is...
So it's like 20%, or why do you say 20?
On your effective tax rate. Every person ends up in a different effective tax rate.
So it is impossible to say like one solution for everybody. There is the same process that everybody follows, but each individual is going to end up with their own number of the deduction.
Absolutely.
Of course.
But what is important to know is it is important to know the items that you are able to deduct, so you could actually calculate what is better, what is more beneficial for you to use, whether it is the standard deduction or the itemized, correct?
Absolutely. I always have my clients still bring in their mortgage interest statement, calculate their charitable, medical, DMV fees, just so we can see if they are going to reach that certain threshold to be able to itemize.
Correct. And if your mortgage interest and all of those items are less than the standard deduction, you just go with the standard deduction and you still get the break. Correct?
Correct.
Excellent. That's what we wanted to hear. So, for the mortgage insurance, so we talked about the mortgage interest. Now, the mortgage insurance premiums, PIMI, like, is this a part that could possibly be deducted, or would it be on the list of those items to be deducted in terms of if you're doing an itemized deduction?
Unfortunately, as of 2022 tax year, they removed the mortgage insurance premium deduction.
Really?
So it is no longer deductible as a personal itemized deduction. However, if you own an investment property, you are able to claim that as a rental property.
Interesting.
Perfect. So
Expense.
So it is not for the owner occupants, but for the
Yes.
Interesting. And I know it's like, is it the same thing with the FHA mortgage premium that we pay up front? Is that something that could be possibly deducted?
Yes. So the mortgage insurance premiums, along with the mortgage interest, property tax, you are able to take the full amount on your rental property, even if you are not able to itemize.
FHA is usually the owner occupied. So would you say that you would recommend everybody who's coming to you to prepare a tax return, or to their tax preparer, to their tax professional, would you say it is important for them to bring that closing statement if they purchased the property in the year before? So is that a document that should be, like, that your tax preparer, tax person should be familiar with and should be provided when you're doing your taxes if you purchased or sold the property?
Yes, because sometimes on the 1098 statement, there are points that you paid which may not be reflected on the 1098, but it is in your closing statement. So you definitely want to bring that in so you can use that as an itemized deduction as well. Lender points.
Oh, that is something that I missed. So if you pay down the points to buy down your interest rate, that could go into the itemized.
Absolutely, yes.
Crystal, is that a practice that our front desk asks whether the clients, when they make an appointment, they bought a house and to bring that in, or do you have to reschedule for that?
I don't think that we are asking that. We should start going forward, but most of the time when my clients do buy a new house, they automatically bring that in because they don't know if they should or not. Okay. So a lot of my clients, they do.
I mean, for our brokerage as a practice, as of January 1st, like in the month of January, we send the closing statements to everybody.
That's so helpful.
And yes, we send it over, and as a reminder,
take it to their CPA?
Yes, we remind them to take it to the CPA, and we send it we send it to them once again to say, this is the document, please don't forget. And in fact, right now, right before 50, in September, we send it out to our investors once again, just in case that they extended their taxes. And right now on October 1st, we're again sending it out, as a reminder. And we have a lot of our clients coming back to us and asking for those, and we're gladly providing those. And just a little side note for everybody, guys, those who are watching us, just remember, all those documents are retrievable. Your real estate agent, your escrow company, we're actually keeping those documents by law. We have to keep them for 7 more years. So it doesn't cost you anything. All you need to do is just to make a phone call or email us. Anybody, your agent, should be able to provide you with those documents. So please don't be shy, and there's no charge for providing those documents. And Crystal, thank you so much for reminding us, because I think that David would agree that in today's day, the fact that almost every single person is buying down the interest is a fact. Like there's a ton of money
last year.
spent.
Yes. This year.
Yeah.
Last year.
Now, if you allow me to go a little bit deeper, and feel free, Crystal, to say that, like it is not supposed to be answered on the camera, but let's say if the interest was purchased down, but we use the seller's credit for it, does the purchaser still gets the benefit of write-off or no? Logistically.
That question.
David is shaking his head.
I'm like, maybe David would know, but no, I don't think so.
I don't think you can deduct something that you haven't paid for. Seller's credit means it's an expense added to the seller's expense when the seller, does their taxes. It was added as a contribution. If you look at the both columns of the settlement statement, that's going to be something that the seller paid, and the seller does their taxes depending on what kind of transaction it was. So one big rule with the IRS, and it spills over into everything you do with the IRS, is there's no double dipping. Every dollar can be deducted once, and that's one of the biggest rules that the IRS has. You cannot deduct $1 once. If the seller's going to deduct it, you don't get to deduct it as a buyer.
Perfect. So, but I think it is a very important information for our sellers to hear that once again on that closing statement, you're going to see all the contributions that you made towards the buyer's closing costs. And as Crystal said, talk to your tax professional. There is a chance that it is deductible. Excellent. So we keep on going through owning the property as your primary residence. So we can deduct the property taxes, correct?
Yes, property taxes are deductible.
Excellent. So can you talk to us a little bit about the sales, like the benefit of owning the personal property for more than 2 years, and then if we sell it, is it true that we get to have the tax-free capital gains? Like for a single person, it's $250,000. For a married couple, it's $500,000. So could you please elaborate on this a little bit? Like how come we get to save and how often?
Of course, this is my favorite thing when a couple comes in nervous because they just sold their home and they don't want to pay a lot of taxes, and then I do the calculation, how much you bought it for, when did you sell it, how long did you live there, and then I tell them, guess what, this is tax-free money, and their face just lights up. So yes, if you sell a home and your capital gains is under $250,000 as a single filer or under $500,000 as a married couple, that's money is not taxable. We do have to file a sale of a primary residence form. So that's one thing that a lot of tax preparers fail to even put on the taxes because they're like, oh, it's tax-free, no need to report it. You should absolutely still report it because later on down the road, you may get a letter from the IRS that says, hey, we see that you sold this home. You didn't include it in your taxes. They don't know if it was an investment property or your main home. And you may get a scary letter that says you owe them, $20,000, $30,000, $40,000. So absolutely still just report it. So you're doing your due diligence for the IRS, and then just know that you won't pay any taxes on it. There have been some cases where I've had people pay slight capital gains only because it was over the exclusion, but it wasn't as bad as if it was the full capital gain. So
Crystal, if I give you the example, let's say I bought a property for $200,000 and now I'm selling it as a single person. Now I'm selling it at $500,000. So I pretty much made $300,000. However, I still have my primary mortgage of $100,000. And let's say I took a HELOC of $150,000. So I owe total of like $250,000 on that property. How does how does this unfold on my taxes?
Paying off the mortgage? Unfortunately, that would not be a write-off. So it's only from what you bought the home for and what you sold it for. If when you sold the home, you had to pay off the HELOC or the remaining primary residence, the amount of it, we cannot include that as a deduction.
So it doesn't matter how much I owe, it's the difference between the purchase and the sales
Correct.
price.
But but if you made any home improvements, if you had to pay all your closing costs, that will also be a factor to help reduce your capital gains as well.
And David, did you want to mention something?
Yes, this is something, a huge misconception that I would say if you're not a tax professional or have an accounting degree, that you're going to get this wrong. It's very important. Most people commingle the understanding of buying a house with financing it. You need to understand those are two different transactions. When you purchase a property and when you pledge that property against and finance it, borrow against it, those are two different transactions in the eyes of the IRS. Okay, it's important to understand. So when you talk about capital gains exclusion, you bought it for $100,000, sold it for $300,000, you have a $200,000 capital gain. That has nothing to do what your loans were, what you borrowed, whether you borrowed $100,000, $50,000, then subsequently borrowed more, then paid it down. It has no consequence no effect whatsoever. Your basis, the IRS wants to know what you paid for it, or your basis, how much money did you spend on improving it, but that goes up. If you buy a $100,000 property but spend $20,000 in improving it, your basis, your cost is $120,000. Now you sold it for $300,000, you got $180,000 capital gain, which becomes free in your example, right? And then you subtract your transaction costs because you had closing costs when you bought it, you had closing costs when you sold it. That gets subtracted as well, and we determine your true income that you need to pay for.
So, and when we talk about owning their personal residence, we know that by stats in Las Vegas in particular, most people are going to own their personal residences between 5 to 7 years. So there are a lot of things that I would do to the house that could be done, a lot of improvements that could be done to the house within that time frame. What is the best way for me to track them? Like, do I have to report it to my tax professional every single year, what I have done to the house, which based on what David said, like to increase that basis? How does it work? How does the process work? And Crystal, if you could give our listeners a good kind of like mundane advice, what they are supposed to do, what is the best practice?
If it's your main home throughout the year, improvements technically are not deductible unless you install solar, if you install energy efficient appliances, things like that. You may get a tax credit for those things. So you do want to keep records of everything that you do to the house, even if they're not tax deductible. So in the future, when you do go to sell, you can add those amounts to the basis, like David was saying. So just record keeping. So your invoices, your receipts, I'm
just going to raise my hand so I don't interrupt you. Sorry, Crystal. When you're done, I'll add something.
Okay. So that's the biggest thing. And yes, you think about holding on to these documents for, I have to keep them for 5 years or 7 years. Yes, but down the road, like I said, if you may be looking at a higher capital gains tax and not making the exclusion, it'll help you to pay less taxes at the end of the year. Yes, David.
A lot of people actually, Alexandra, they actually convert the house to a rental. So keeping records, no matter, even if you live in it, it's still a good idea. Just get in the habit of keeping records of what you paid to the contractor, the invoices, the canceled checks, because not everyone lives in a house and sells it, but they actually convert it into a rental, buy another one. So in that case, as soon as you move out, as soon as you consider that a rental income producing property, all of your expenses become deductible.
Absolutely.
So record keeping is important.
So the best thing that you would recommend, no matter how long you're planning to stay in the house, you should be keeping your records.
Absolutely.
You should be keeping your records for all those years on the improvements. And you did actually touched upon the one of the topics that I also wanted to talk about is getting solar, because a lot of people are confused.
Absolutely.
They're leasing solar, they're buying solar panels, and they're trying to find the value. And unfortunately, when we get to appraisals, we don't get much value on the appraisals. So can you please give us, like, shine some light over here if there's any tax benefit of owning solar and having solar on your house?
Yeah, so the biggest misconception with solar is people are thinking that they're going to get that 30%.
Oh, you're probably getting a call. Crystal, I'm sorry. Can you please repeat it?
Yes.
Yeah, probably.
So
one of your clients is
with solar is that it's not a tax refund. You don't get that 30% money back. You get a tax credit, and it's 30% of the total amount that you spent, and you get to.
Hold on.
Crystal, you may have to put your phone on a focus mode or sleep mode so phone calls don't barge in.
Yeah, I think it's really hard, for us to ask Crystal not to answer her phone, or for her phone not to ring at this time of the year.
We have a front desk. She's not taking the business calls, so.
Okay, that should be a lot better. Sorry, just had to.
Thank you so much. And Crystal, sorry, can we please ask you to just go again through that sentence? So.
Yeah. So with the solar, you do get a 30% tax credit, which you can use on your taxes for the next 5 years. However, and it just reduces your tax liability. So solar is a really huge tax credit. If you lease them, there are no tax benefits. If you lease solar, you have to purchase solar. And in the year that you purchase them is when you get to take the tax deduction, the tax credit.
And if you can take it within the first year, you can actually extend it over the period of 5 years, right?
Yes. So until the credit is fully used, you can have that deduction each year. So if you have a tax liability of $3,000 and you have $15,000 in a solar tax credit, then your tax liability will essentially be zero, and then you're going to get back pretty much everything that you had withheld on your federal taxes. So you do get a bigger refund.
And did you say that it is on federal taxes, or you said it just because we're, once again, for everybody who's watching us and not familiar with us, we are located in Nevada?
Yes.
So everything that we say is portrayed to the state of Nevada. If you guys are watching us from a different state, please do consult with your professionals, with your local state professionals that are going to be more familiar with the state laws. And we are blessed here in Nevada not to have the state tax, and I think that it might be making it easier for Crystal.
Yes. So
that
is the one thing that I do hear is when my client comes in, they said, I got solar. My salesperson told me that I get to get 30% of that back as a total refund. Mm-hmm. And then I have to go in and tell them, no, that's not the case. You're not going to get a 30% refund. You just get a tax credit, and they kind of get discouraged or upset. And then I have to go in and just explain like the tax law and go over it, because they're looking like I'm telling them something wrong. And that was just the biggest thing that I do hear when people get solar, is that they were kind of persuaded.
Salespeople present solar in a very different manner, far from the actual tax law. That's true.
I will 100% agree with you, and thank you, Crystal, for mentioning it and bringing it out, because it is true. And I can tell you that personally, myself, I was engaged in this conversation with the company that that installed the solar on my personal residence. And unfortunately, the salesperson who was very eager to make a sale, but at the same time they were crossing the bridge. Like instead of doing what we're doing, getting the tax advice from the tax professional, the salesperson took it upon himself to make the promises, and he pretty much his statement was along the lines that if you can use that money towards your taxes, or your monthly payment is going to go down.
Yes.
But the truth is,
I hear that all the time.
This is what a lot of solar people say, and I think that the best piece of advice that we can get, that we can give out over here and bring to everybody's attention is that if you're thinking of purchasing solar, give your tax advisor a call.
Absolutely.
And verify, before you start relying on the data that the sales professional tells you, because I get a ton of mortgage and tax questions from my clients. But the best thing that I can do is to say, guys, I'm not equipped. I might have heard something, but I'm not equipped to answer this question. Why don't you talk to a professional that you can rely on? Why don't you talk to a person who does it for a living? I'm the real estate professional, not the tax professional. So once again, guys, if you're looking to buy solar, before you make your decision based on the salesperson tax advice, go to the tax professional and actually get this explanation. And I'm pretty sure, Crystal, how long does it take for you to break it down for a person? It's probably 5-minute phone conversation.
I was just going to say about 5 minutes. Yep. And sometimes I had the unfortunate clients who have like 3 or 4 dependents, education credits. They have so many other credits that their tax liability is already zero. They don't even end up being able to use their solar credit. And every year it just keeps rolling over and they're not taking that credit.
So yeah, guys, it's not like Crystal said, not everybody will be able, even if you're entitled to that credit, it doesn't mean that you are going to take the full benefit of it on your taxes.
Yeah,
and
absolutely.
Obviously there is no check. There is no check for installing your yeah. So there is no rebate check, and this is exactly what unfortunately, a lot of solar salespeople are advertising, that at the end of the year, you're getting a check. Nope, you're not. You're not. But thank you so much for actually explaining it to
Crystal,
us.
Can I interject and say, if the person was W-2 and they have paid into federal taxes, and if the solar credit does zero out the federal tax liability, then that will result in a check that's not from the IRS, a tax refund, which is what the taxpayer paid into for their own taxes.
Absolutely.
Yeah. So some people may get a
rebate check from receiving the solar.
That's not tied to the solar panel directly. Yeah.
Perfect. Thank you so much. So this part of the conversation was in regards to owning the personal property, and I'm pretty sure that there are a lot more tax deductions and the tax benefits of owning your personal residence. But can we tap into actually investing in real estate and the major, the biggest benefits, the biggest tax benefits of owning real estate? Crystal, what would you say, number one, the biggest tax benefit? And if they intersect with the owning the personal residence, please let us know as well.
Of course. Well, what I see sometimes the biggest benefit, sometimes you don't want to claim a loss, but sometimes rental losses can help reduce your taxable income as well. Because on top of being able, of course, you have to report the rental income. However, you're going to now take depreciation on your home over 27 and a half years, meaning you're actually writing off the cost of your property. You're going to anything you do to this investment property is now a deduction. Like I said, no matter if you itemize, if you don't, mortgage insurance, property tax, interest statements,
Homeowners association,
home warranty, yes. Traveling back and forth to the property. Some people have properties in different states, so you can deduct your airfare. Like literally, it opens up a whole can of worms of what you can actually write off now. So it's like if there was an expense for your rental property, it's deductible now.
And property management fees, correct?
Oh yes, property management fees.
Improvements.
The HOA, that's a big one now. The HOA, you can absolutely write all that off.
Perfect. And Crystal, can you please, I think this is something that most people do not even think about, and they really, really overlook. Can you dig a little bit deeper about the depreciation of the entire property over the period of 27 years? So does it mean that if I buy property today at $500,000, over the next 27 and a half years, I get to depreciate the entire $500,000?
No. So
okay.
You can't. So the only thing that you cannot deduct is the actual land itself. The land is not taxable. So we do have to kind of calculate what. Yes, the land is not depreciable. So we have to kind of calculate what your land value is and exclude that from the actual cost of the home. So maybe if you bought a $500,000 home, the land is probably like $200,000, $180,000. So we do have to exclude that from the total cost.
So
go ahead.
So this is probably something to tell our viewers, Alexandra. This is the number one mistake that I used to see when I was preparing taxes. And this is still the number one mistake since I have the background. And as a loan officer, I do get the taxes that clients send. For us to pre-qualify, we keep seeing the same mistake. Most people that prepare their own taxes on TurboTax, they do not know how to depreciate. And this is, in my opinion, the most dangerous and biggest mistake you can make, and to invite the IRS for an audit. And it does happen quite often. And it's interesting, I was talking to Andre yesterday, and we had a client, extremely educated, patent attorney out of East Coast, has a bunch of properties, very well off, and he keeps doing his taxes. He does a really good job for not being a tax preparer, and he's still depreciating it wrong. And it opens
because
such a big.
You can't know it all. Like even the tax.
Yeah.
Because we take. I'm pretty sure, Crystal. Do you take continuing education?
Absolutely. Every year I have to. The tax law is constantly changing. So
you guys have some coming up in November and December, seminars.
Exactly. So something can be deductible this year, and then the next year it's not. So it's always good to stay on top of things.
Absolutely. And I envy those people that can do their own taxes and prepare their own taxes and actually take all this education, but chances are the professional does it a little bit better than you. And the price of any professional tax preparer usually is way cheaper than the price of the audit and, God forbid, any IRS penalty.
Yes. But with that being said, if you have an investment property, your tax preparation fee is a deduction. So
thank you.
It's like a win-win.
Thank you. So it's pretty much, it doesn't cost you anything to do your taxes right if you're investing in real estate. Absolutely. It is a tax deductible fee. And thank you for mentioning that, because it is also extremely important. Now, Crystal, let's talk a little bit about the capital gain taxes when we sell investment properties. So if I flat forward sell an investment property and I just want to cash out, So what happens? I don't get the 250,000 because I'm not living in this property. So let's take the same scenario. I bought it for $200,000, sold it for $500,000. Am I paying the taxes for the difference, like $300,000?
Yes, you are. If you never lived in the home, then yes, you will have a capital gains tax of $300,000. But on top of that, the depreciation that you took over the time of the owning the property, you have to add that back as the cost. That gets added back. So you do have to eventually pay the taxes on the depreciation as well.
Always, or
Always.
if I always?
Yeah,
even if you don't take depreciation, yeah, even if you don't take depreciation, which some people feel, well, I'm just not going to take the depreciation. The depreciation always gets added back in, even if you chose to take it or not. So that's why it's always just best to just take the depreciation, because no matter what, you're going to be taxed at the end of the year.
This is probably the most common mistakes that tax preparers make.
Mm-hmm.
Okay, I'm going to talk about mistakes that others make, people make, and tax preparers. Alexandra, the most common mistake that tax preparers make is they're like, you know what, let's not take depreciation right now. So when you sell the property, you won't have to pay depreciation. That's not how it works. The law says depreciable, allowed or allowable.
Yeah.
If it was allowed, it was allowable, and you didn't take it, that does not save you from paying taxes from depreciation recapture. Go ahead and take your depreciation, use it. You're gonna have to pay for it no matter what. So you gotta take depreciation. Do not listen to some of these tax preparers that don't know what they're doing. I've seen more than I can count that mistake on other taxes, more than I would want to see, a lot.
Okay, guys, your statements right now not making me happy. So why would I still invest into real estate?
For the benefits.
So if I'm doomed to take all of these taxes, like, is there a way for me not to pay the taxes, or should I use the 1031 exchange to defer the taxes?
That would be your best option. If you're planning on buying another property anyways, it's better to just do the 1031.
Can you please tell us a little bit of the benefit of 1031 exchange for the investment property? So what is the 1031?
So with the 1031, you are just deferring the capital gains tax until each property is completely sold. So you're not going to
until your history.
Oh yes, or until your history. So instead of paying the tax on the $300,000 now, you get to buy a like-kind property and then just keep deferring the capital gains tax for the future. So,
and if you buy that property for less money, then you get to, you get to pay the taxes in increments, correct? So, like, let's say if I bought the house for $200,000, sold it for $500,000. And immediately bought another house for $450,000, like reinvested that money. Mm-hmm. The $50,000 difference, that becomes my, the part of my tax liability for the year, correct? Because I purchased the cheaper property.
Correct. I think, Dave, would you know a little bit more about?
I wasn't. Oh, I'm sorry. What was it? What was the
You were not listening.
I'm sorry. What was the question?
We were talking about the 1031 exchange. If you happen, because the 1031 exchange usually says you do get to buy equal value property or higher value property.
Oh, you can buy a higher value property. That's okay.
What if you buy a lower value property? Like, you will be actually paying, like, the year that you sell your property. Let's say if I sold the house for $500,000 but bought for $450,000. So that $50,000 difference becomes immediately taxable on the tax return of the year I sold.
Because you bought a cheaper property? You know what? I'm not sure. Here's what we've relied on, Alexandra. I'll be honest with you. When one of our clients sells a property, there is a third-party 1031 exchange company with their attorneys that they make sure that this is kosher and it's going to go through. So whenever we get the documentation from 1031 exchange company, we know their attorneys have looked at it and it's okay. That's what the tax preparation is based on. If you buy a cheaper property, let me rephrase. I don't think that your questions, I'm going to say no. When you have capital gains, let's say you're selling a $500,000 property, it really doesn't matter how much your property is. What matters is what your gains is, what your taxable income.
Yeah.
That full gain, we're kicking the can down the road, for a lack of a better example. So we're taking this gain, we're applying it to another property. So we're taking this $300,000 gain, for example, putting it into a $450,000 property. Okay. So now we're only financing $100,000, let's say, or 150,000. Okay. If the number makes sense. So if you cannot use the full gain and the escrow company has to give you a refund back, that becomes taxable. Okay.
Yes, you do.
If you cannot transfer the whole capital gain into another property, there's leftover. So when you sell the property, that funds is sitting with the 1031 exchange company. After the transaction closes, the remainder, which is called the boot, you get the boot, you basically get that money and you pay taxes for it. I'm not sure if that's what you're asking, but that's
yes, this is what I was asking, and I would like to remind to everybody who is watching this live or who is going to watch it into the recording, when we do the 1031 exchanges, once again, it is a complicated process that should not, and I repeat, should not be done on your own. And it should, like Crystal, would you say that, would you say that it is not something that, should be handled by your tax preparer, by your tax professional, unless they are specifically 1031 exchange professionals? Would you say that, you wouldn't handle that process for the client?
Like
you
doing
would
the exchange and everything?
That's
like
that's not a tax preparation.
No.
That's not a tax preparation company, Alexandra. So we're doing a loan for a client and he's in a contract. And all of a sudden he's like, you know what? I want to sell my property and put my proceeds into this property. I'm like, you would have to get out of this contract. You'd have to cancel. So 1031 exchange takes careful planning. Talk to your realtor. Realtor is the number one person to talk to, because you're going to talk to the escrow officer. Escrow officer is going to refer you a 1031 exchange company. This is not much to do with Crystal or a tax preparer, CPA. They could give you an advice of what's going to happen, but handling of the money, when you sell your property, these funds are going to go sit with a 1031 exchange company. They're not going to release it until your period is over, which is 45 days. You have to identify a property. You have to close on the property within a certain rules. And after that, if there is a remainder, they will release the remainder back to you. So, and they're the ones that dictate the rules and how it's going to work. So you got to let everyone know, start with a good realtor, good escrow company. They will refer that before you even list your property for sale.
Correct. And that's why during the listing process, once we go to the listing appointment, one of the questions that we usually ask our sellers is, what do you intend to do with the money? And if there is a chance that one of our sellers is looking to do a 1031 exchange, this is when we involve the 1031 licensed 1031 exchange company, because as realtors, we're not equipped to talk to IRS. So we're going to follow the process and help you with the process, but we cannot handle it for you the way the 1031 exchange is going to handle. And at the end, the 1031 exchange is going to produce the paperwork that is later on, like at the end of the year, is actually delivered to your tax preparer. And this is the part that Crystal is going to handle.
Yes.
And so it is important to use right people on right spots at the right time. And the full disclosure is what keeps us out of trouble every time. That's why we ask you guys questions when you're transacting with us. we ask you the questions not because we want to be nosy, but because there's a lot of knowledge that we don't want to offload on you at the same time and confuse you. However, we're looking for certain answers that will help us help you to protect you, your income, and to protect you from certain liabilities.
Absolutely.
Crystal, can you please talk to us a little bit about the home office depreciation?
Oh, yeah. So with the home office depreciation, if you are self-employed individual, you are able to deduct the total square footage of your home and the total square footage of your office space. So it's not the full percentage. So you are able to deduct like rent paid, repairs, utilities, like little things like that as a home office write-off.
Excellent. And
gives you a little bit
the furniture, if you purchase the furniture for that office?
Yes, like if you have a home office, let's say you put like a sofa in there, you bought an office, a desk, chair, computer, just to set everything up, you are able to take depreciation on those items over 5 years.
Excellent. And now, just because we have David over here, and it's such a rare, and once again, Crystal, thank you so much for giving us your time. And can you guys both just talk a little bit how important it is to actually have a tax preparer and a mortgage person work hand in hand and keep you, keep them informed if you're planning on buying the property? Because a lot of people think that, the moment, I'm going to take care of those things the moment I decide to buy a property. Like, the day I decide to buy, this is when I'm going to, this is when I'm going to, just throw my taxes at the mortgage person, just load them up, and I'm definitely going to qualify because I live well, I make good money. And David, can you please talk a little bit more about how important it is and how soon you're supposed to get the preparation for your mortgage, or what should you do and why should your mortgage person be aware of what's going on with your taxes?
So taxes is one of the three main components, the CIA, the credit income assets. That's one of the more important components. A lot of times people make mistakes, and because of those mistakes, they don't qualify. They cannot buy a house. This happens every week. We tell a client, you don't qualify because you deducted too much or you didn't show enough income or whatnot. You got to wait till next year before you buy a house. So for that reason, Crystal has a procedure. Crystal does ask a question to every single one of her 2,500 clients. Are you planning on buying a house this year? If they are, then I will pop back in if they would like to use me, and we would like to consult them right off the bat. During tax preparation, what kind of house are you trying to get? David, I'm trying to get $1 million house plus $200,000-$300,000 investments. Awesome. Okay, you need $1.6 million purchase power. Here's how much income you need to show. Maybe you can defer some of these expenses to next year. Maybe you could take some depreciation here within the laws, within the legal limits of what we can do. We will prepare that your taxes so you are able to buy the real estate that you want. So that's an extra conversation I try to have with my clients in the beginning, and then go about their life. And several months down the later, they come, David, I'm ready. Let's get that house. Okay, well, your taxes are ready too. So talking to your loan officer and making sure that your tax person, loan officer are in communication is probably the smartest thing you could do if you're planning on buying properties and building wealth that way.
And I think this is this golden piece of advice that we can leave for our listeners and our viewers, is that if there is a chance that you're looking to buy a property this year or coming year, it is extremely important that you tell your tax preparer about it. Yeah. And once your draft of your tax is ready, you actually talk to the mortgage officer. Because, Crystal, is that true that certain deductions could be extended to the next year or 2 years? So there is a way for people to still take a benefit of those deductions. However, not to do it on the year that they're purchasing the property if it's going to actually define whether they're qualifying for a mortgage or not.
Absolutely, it does. Some things can be hurtful and some things cannot. So it's like, hey, we don't need to claim this year, or we don't need to claim the full amount. We can depreciate it and defer for the next year. Absolutely.
Absolutely. And this is something that people kind of when they do not have the tax office or tax preparer, tax professional talking to the mortgage person, what usually happens that people come to you, Crystal, and they say, we want to pay as little tax this year as possible.
But we want to buy a house at the same time.
Yes. But it doesn't
don't mix.
Yeah, it doesn't usually go like that, because if you're saving, like if you're deducting everything to like 100% as you can, usually you end up with the income or with the end number that is not going to to help you qualify for the mortgage or for the house that you actually want to. You might qualify for a house, but for a mortgage on a house, but it might not be the amount that you want to. And that's why it is extremely important to have, first of all, Crystal, tell us a little bit about the timeline. What is like when people should start coming into your office? And if they still can. I know it's today, what is it, the 27th?
Yes.
So September 27th. So can you just brief us and give us the idea, like when should people prepare? When they should come to the office, like what's the best timing? What's the worst timing to actually come to you and ask you of anything?
Oh, I would say before the end of the year. That way when January, February comes and you do want to file your taxes before April, you will have everything that you would need. You can start gathering up your documents. You can start getting everything done. I have a lot of people who choose to do like a consultation with me November, December. That way they are prepared when it comes to January and February. They're not worried about it. During that time, if they want to purchase a home, I can start letting them know what they need to prepare and gather. So when we do prepare the return, everything's ready to go. They don't have to, try to find all these documents and everything. They have it set. The worst time to come is when it's like April 15th and you're like, I need to get my house, I need to get this, I need my home, and I want it all done, the last day of the tax season.
So you would recommend the last few months of the year?
To come in before the actual season begins so that when it does start, you are prepared. And then we even get our tax software in the end of December, early January. So we are able to make like a draft for you so you can kind of see what you're looking at before you actually file.
So if you're looking to see the draft and to actually do a thorough work and have a thorough consultation on your taxes to understand it all, the best time to address it with the tax preparers is going to be November, December.
Yes, because we could do like your year-to-date statements. It'll kind of give us a better picture of exactly how much income you're going to have, the expenses that you're going to have, so we kind of have a good picture, because you're probably not going to end up buying, something major towards the end of the year.
Or you may if you need the depreciation.
Yes. So I would like a bigger deduction by the end of the year. I say, yes, go. You want to get that car, go ahead and buy that business, vehicle, so that
that's what the billionaires do, right? Elon Musk and Grant Cardone's, they get their tax snapshot early December, and they go buy an airplane so they can depreciate, or they sell stock or whatnot. So you do have some days in the year left over. You could do certain things if you know what your tax liability is going to look like.
So November, December is the perfect timing for those smart, calculated people to actually understand where they at with their businesses, with their personal tax returns, to talk it over with no rush with the tax preparer, with their mortgage officer, with their financial advisors of what their moves should be, and actually take those moves within the last 2 months of the year where majority of people would probably already go on to vacation mode.
Exactly.
And
So
not
before you
think
go
about it.
buy all your Christmas presents, let's get your business and personal taxes situated.
And Crystal, does it cost anything for the consultation? Can you tell us a little bit more about it?
Our consultation is only $75 for the hour.
Excellent. And what is the best way to request a consultation with you?
Just to call our office or email us. Our front desk, she's on top of it.
Why don't you give
Okay, do I have
the phone number? It's 702-871-7884.
Perfect. And it is IQ Tax, correct? And I will be posting the information for your front desk and the phone number to request the appointments at the bottom of this email, so that anybody who watches us later on can actually relate to it. Because David and I, we do speak other languages. Do you guys have anybody in the office who speaks Russian, Ukrainian, Armenian? Can you please elaborate to that for our post-Soviet Union, post-Soviet Union immigrants who feel more comfortable when it comes to finances, when it comes to taxes, to actually speak their comfort language.
Because I do my best, but if there is a barrier, we do have Ani, who speaks Armenian and Russian as well, who can help me translate.
Excellent. So for those of you guys who are watching,
Crystal is working on her Armenian and Russian because she wants to be a kukla.
She already looks like a doll. She does look like a smiling doll, and thank you so much. And she's, she's a smart doll.
Thank you.
Yeah.
That's what we call it. Yes. And thank you so much. We're grateful for your time and for everything that you taught us today, for all those little bits of information. And do you encourage the people who are actually watching us right now or later on to reach out to you? Do you guys take additional clients, and are you guys open for more business?
Yes, we're open year round. So if I would prefer, if all of my clients, every year towards the end of the year, just stop by. We had a quick conversation. That way, when it do come time to taxes, everyone's just prepared. That's the best thing.
Yeah. And Crystal, you said it a couple of times to stop by, but is it possible if the people are out of the country, if they're traveling at the time of the of the tax season, is it possible for you guys to do the virtual consultations to help them remotely, or is it always in person?
No, I have clients all over California, New York, who are show performers, so they're in different countries. So yes, I can Skype, I can do WhatsApp, so whatever you're comfortable with.
Thank you. Thank you for being so accommodative. David, anything else that we forgot to mention?
No, I think we covered a lot. It's more than one person can digest. I think it was very good. It could even be broken down into little clips, and you had a very, very good list of questions, Alexandra. Thank you.
Yes, you did. Thank you.
No, thank you guys, because I know that Crystal was very generous with her time, and thank you so much again. And is it true that for those folks who have not filed their personal tax returns yet, there is still time to come and see you, or you don't want those people?
No, absolutely. We have until October the 15th, so come on in, or call me, or email.
Thank you. Thank you again, guys. And I really appreciate you both joining us today on this live. And you guys have a wonderful week. Great to see you. And we see you next week.
Thank you.
See you.
Bye-bye.
Bye.